Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to do it in no more than the time you would have available if you want to enjoy a quick cup of coffee while listening to the podcast. Today I'm talking about contributed tax capital, or the abbreviation is CTC. And I'm going to specifically focus on what can or can't a company do with its CTC. So before we go into what can or can't be done, I would like to just revisit the concept of CTC and explain what it means and how it works. So CTC, if we look past the detailed requirements of the law and we just look at, in principle, what it is, it's really the balance of the amounts that the company receives when it issues shares from its shareholders and the amounts, that portion of these amounts that it's since then given back to the shareholders. So CTC is a tax concept. It's not linked to the Companies Act or what you do for accounting purposes, although I think in principle it should be possible to align, for example, your share capital account with CTC if you apply the concepts of the tax definition of CTC to account for share capital in a similar way. So what's also important is that it's a balance that you need to keep for each class of share that the company has issued. So when a company makes a distribution to the shareholders of that class, so in other words, pays a dividend or does a share buyback from those shareholders, the board of the company can choose whether that distribution reduces the CTC or not. And this is a choice that the board must make before the payment of the distribution is made. Now, if the payment reduces CTC, then the distribution is called a return of capital. If the payment does not reduce CTC, then the distribution is called a dividend. So our focus for today is on the return of capital element of these two. So what are the tax consequences of return of capital? Firstly, it is not a dividend. And the importance of that is that it's not subject to dividends tax. Now, a return of capital reduces the base cost of the shares in respect of which that return of capital is received. And that's the rule that applies if the shareholder does not dispose of the shares in the transaction where it receives the return of capital. And it could be that the return of capital is more than the base cost of the shares. So that would, for example, happen if you've got one shareholder that subscribed for shares in the company longer ago or longer further back than the first shareholder or the subsequent shareholders. So let's say the first shareholder subscribed for 100 Rand. A few years later, the value of the company has grown and another shareholder subscribes for 1 million Rand. So now the pool of CTC attributable to that class of share is the 1 million Rand plus the 100 Rand. And when a distribution is made to the first shareholder, that shareholder can possibly receive an amount from CTC equal to his proportionate interest in the shareholding, and the CTC that's available there would be his proportionate interest of this pool of CTC. So in other words, the 1 million Rand plus the 100 Rand. So then it could happen that a shareholder receives more CTC or a return of capital that exceeds the base cost of the shares. If the shareholder receives the return of capital in disposing of his shares, so for example a share buyback, then the return of capital would be treated as proceeds. So because the return of capital is not subject to dividends tax, it may be very attractive to some shareholders and not so attractive to others. So if we look, for example, at an individual or a trust receiving a distribution from a company. So for those persons, if they receive a dividend, that distribution would be subject to dividends tax at 20%, whereas if they receive a return of capital, there's no dividends tax on that, but it reduces the base cost of the shares, which would have a tax impact somewhere in the future when these shares are sold. So they may prefer the return of capital if it's a choice for them. And we'll talk about these choices and when the company can make these choices or not in a minute or so. If we also think about foreign shareholders, for example, if an amount flows to them as a dividend, it's subject to dividends tax, whereas if it flows to them as a return of capital, it reduces the base cost. But I think what makes their situation even more different is that in a lot of cases, these foreign shareholders will not be subject to CGT when they dispose of the shares. So they are really indifferent as to whether their base cost is reduced or not. So they would definitely prefer not to receive a dividend, but rather a return of capital, if it's possible, of course. If we then look at the other side of the equation, if we've got a South African company shareholder where there's a company-to-company exemption from dividends tax, that shareholder would prefer to receive a dividend where there's no tax on it, rather than to receive a return of capital that reduces the base cost of their shares. So they would prefer to keep the base cost of the shares intact. So that then brings us to the question, can a company choose to pay a return of capital or CTC to some shareholders and a dividend to others? Now the answer there is no. And I think we need to qualify it slightly to say not anymore. So previously, the definition didn't explicitly forbid this, and there were some interpretations that that one could have followed to say, but it is actually allowed. Now, since 2023, the National Treasury have amended the legislation, and it now says that if CTC is transferred to a shareholder, then the CTC must be transferred proportionately to all shareholders who participate in the distribution. So in other words, you can't choose to transfer CTC to some shareholders in a transaction, but not to others. So what that really practically then means is when the board makes its decision whether to transfer CTC or not, it needs to balance the interests of all the different shareholders in the company. And some of them may prefer the return of capital and others not. So in closing, I think it's safe to say that the space to manage CTC in a way that's beneficial for some shareholders and not for others, that opportunity has been closed. So all shareholders must be treated the same from the perspective of CTC being distributed or paid out to them. What it then also means is that the board must be cognizant of all the restrictions on how CTC can be used. So I've mentioned some of them, but the definition is quite technical as to how much CTC can be transferred and how much can go to a specific shareholder. So that's it for this episode. Thank you for listening. And if you've enjoyed the podcast, please subscribe on your podcast platform and tell all your colleagues and friends about it. If you've got a topic or a question that you would like me to consider in a future episode, you are more than welcome to send me an email. My email address is in the show notes below the episode. Then I will have a look at that and consider to possibly do a future episode on that. And as always, nothing in this podcast should be construed as tax advice or even in a replacement for fact-specific tax advice. Until next time, goodbye.